Let's talk about the state of the housing market. Where do we expect interest rates to go? What do we expect for home values? Are we going to see continued appreciation? Are we going to see home values decline? Are we going to see a collapse? Let's dive into some of this. I put together a pretty decent slide deck, so get ready for a longer video as we dive into the current state of the housing market. So let's begin this little process here as we get going. State of the housing market. The first thing I really want to talk about when we go through this is that the housing bubble fears are really nothing new. This lovely face you see on the screen, this is CNBC's Diana Olick. Every article on this screen is something that she has put out, and she's been calling for really the collapse of housing dating back to 2014. And, I guess for me, the one that really sticks out to me is homeownership doesn't build wealth, a study finds back in 2017. Just think of how many people would have missed out on massive, massive wealth gains for their families, for their generations, if they would have taken this advice back in 2017. And it's still continuing to this day. Foreclosures surge 181% to the highest level since March 2020. That was March 2022. And that's kind of a no-brainer because in April 2020, there was a foreclosure moratorium put in place where they couldn't happen. So of course they're going to spike when that moratorium ends. Some of this stuff we got to understand, being in the real estate industry, in the lending side of the business, headlines sell. And these are the things that consumers are reading. So let's dive into what's really going on in housing. The first big question we've got to answer is, are we in a housing bubble? I want to take a look up here at the top left-hand side. This is lending standards. You see all this red right up here. This is dating back 2007 and prior. That is how much risk was being absorbed just by the product, by the lender on a transaction. And you can see where the guidelines really changed to make it all borrower-based risk, which means if the borrower doesn't qualify, the program itself isn't going to make up for that shortfall. There's not going to be lending extended in situations that's going to create a product risk. It's all going to be based upon borrower risk. Up here in the top right, this is the total number of dollars lent for mortgages to borrowers with a sub 620 credit score. You can see back in 2006, 2007, we topped out at nearly $400 billion with a B, $400 billion a year of mortgages being written to people lower than 620 credit score. By 2010, 2011, that number had dropped down to almost $50 billion. And since then, it has not increased over $100 billion at all. So we're about 75% better on high-risk lending. Mortgage debt not being a challenge. Now, obviously, this chart is a little bit outdated. We're about 6 months behind on this, so this number will have come back up. But it is nowhere like we saw in 2007, where over 7% of the family's household net income was being spent on their mortgage. Right now, we're probably closer to the 5% range, and that's just because of the interest rate increases we've seen, as well as the housing affordability with home prices being driven up. And lastly, foreclosures, they're at an all-time low. There was a big scare coming out of the forbearance. A lot of people talked about it. I addressed it very directly that I did not believe this would be a foreclosure event, and it's proved to be that. About 80 to 85% of people that went into forbearance are now out of forbearance, and there's been less than 1% of them that ended up defaulting on their mortgage. So the next big question is, why are interest rates as high as they are right now? Look at this chart. This chart dates back to about 2012. And what we see here beginning at the beginning of 2022, right at about 3.1 on the interest rate up to just over 7% as of yesterday. That measures the single fastest and highest climb in mortgage interest rate history. That's what we've seen this year. We've seen mortgage rates rise faster and higher than they ever have in a single year in history. We saw some big years back in the 80s and in the early 2000s where we went 2.5%, but we've never seen anything quite like this. So we got to ask ourselves the question, why? But before I get to that, I want to make a point to address that mortgage rates still are at historic lows. If you look at this chart, prior to 2002, we had never really seen a mortgage rate below 7%. This isn't something that is going to be all that abnormal. Do we think interest rates are going to come all the way back down here into the low twos again? Probably not. We will probably never see those rates individually again. And there's a reason for it. The reason for it is back here in 2010, you see where mortgage interest rates dropped, and then we just held this nice line, and then they dropped again. Well, there's a little thing called quantitative easing. I'm not going to bore you with long definitions on it, but basically the Federal Reserve spent a lot of money buying mortgage-backed securities and buying treasury bills to pull us out of this recession. And then they did it again here on the largest quantitative easing scale in history, which is why we saw the mortgage rates drop as low as they did. So what does this mean for the future? And what is causing it? What's causing the interest rates to spike up that we've seen this year? Well, it's really all inflation based. Think about it this way. If you lent out $150,000 of your money at a 0% interest over 30 years, you're going to get paid $416 a month as repayment for that debt. Now, for easy math, let's call it 400. Let's say inflation, after you lent that money out, crept up 6, 8, 10% in a year. 10% means the payments you receive from that debt you lent out, $400 a month, is only going to buy you $360 worth of goods. The next year, it may only buy you $330 worth of goods. You're losing money on your investment. So what do? Well, you charge a higher interest rate to combat the eating away of your profits from inflation. And that's really what we've seen. We've seen mortgage rates follow very, very closely to what inflation has done. And when inflation comes down, we do expect to see mortgage rates come down. So the big question becomes when. That's the $1 million question in my industry right now, is when do we expect mortgage rates to come back down? Well, I've got a little clue for you on this next chart. First and foremost, let's talk about how inflation is calculated. What we see is the inflation number we see is 8.3%. That's the most recent reading. Well, where does that 8.3% come from? What's that number made up of? It's made up by adding up the month over month increases every single month for 12 months. And that's where you get your 8.3%. It doesn't always equal exact because there's some adjusting that goes on, but it's very, very close to it, which means when August readings came out at 0.6%, it replaced a 0.2% reading from August 2021, which is why we saw inflation increase. You get a higher number replacing a lower number. Well, the September readings are due to come out this month. And again, September of last year was a very low reading at 0.3%. It's definitely something to take note of, because let's say the Fed does a very, very good job in holding inflation to zero in September 2022. Well, if you replace a 0.3 with a 0, you're going to take that overall inflation number only down from 8 to maybe, or from 8.3 to maybe 8%. Now, in October, when that reading comes out, it'll come out in November. That's a much higher reading of 0.6% in 2021. So if the Fed's cumulative rate increases, this is the fastest the Federal Reserve has ever raised the federal funds rate. If that is actually working, which we do believe it is, and it's going to compound, let's say in October, the Fed actually takes the month over month inflation negative by 0.4%. That means we could see inflation, if we get an 8% reading for September, in October, if we get a negative 4%, we take this number out of a positive 6%, we could see inflation drop from 8% to 7% in a single month. We could see big, big gains as we head into the third quarter of this year. Now, keep in mind, the readings for these will always be out a month late. So October's reading won't be out until November, November out till December, and so on and so forth. So we do expect inflation to make a climb down in the fourth quarter of this year. And here's the good news. The Mortgage Bankers Association, MBA, they put out a forecast of where they expect mortgage rates to be. There's a lot of data, a lot of information on this chart, but I highlighted the two things I really want to focus on here. They are predicting, and I'll say this, they've been pretty accurate on a lot of the predictions. they're predicting that at the end of 2022, we see the mortgage interest rates drop down to a 5.5%. That would be a massive, massive win to come down 1.5% from where we are today. By 2023, they expect it to be around 5% and to be around 4.5, 4.4 by the end of 2024. And this actually follows very, very closely to what the Federal Reserve has been talking about of making strides in inflation, but really not seeing it come down to their core level until around 2025. And so I definitely think we're onto something with some of these charts. The other thing I highlighted on this that's pretty interesting is we see the total number of originations in mortgages for the purchase side. In 2021, gangbusters year, we did 1.86 trillion with a T, trillion dollars worth of mortgages for purchase mortgages. Purchase mortgages meaning it wasn't a refinance. These are people buying homes with mortgages. We do expect a slower year, around what is that? I got to look closer. Sorry, $1.61 billion for 2022. That's still overall a very good year. But for the next couple of years, we do expect mortgage purchase business to increase. And this is much due to lower interest rates driving buyers that have been pushed to the sidelines back into the market. Expected to go to about 1.7 trillion in 2023 and back to 1.8 trillion in 2024. So back to that gangbuster style year on the purchase business side. Let's talk about home price growth, the appreciation we've seen. Where's that going to go? We definitely expect the home appreciation to moderate and moderate strongly. We saw this peak out 18.8% on the median. We expect it to come down closer to about a 3% year over year average, which really is good numbers. That's some real solid information. And people look at this chart and they're like, well, I'm not going to buy a home. I'm just going to continue renting if I'm only going to earn 3% year over year. I need to break some of this down for you. First and foremost, let's talk about net worth. We're looking at right now the average net worth of a homeowner in America versus a renter. Now you say, why is there no line for the renter? Well, there is. It's the actual bottom of the chart. This is the average net worth dating all the way back to 1980 of renters in America versus homeowners in America. And this is why we beat the drum so hard. This is why we push so hard that homeownership is an amazing opportunity to build wealth for generations. And I want to dive into why. So people say, 3%, I'm only going to earn 3% appreciation on my house per year. That's not worth getting out of a rental situation. Well, what we've got to understand is the leverage of other people's money. Other people's money is a very important thing. So if we take even lower than that, I want to run these numbers based on a 2% appreciation. Let's say you're buying a $400,000 home today at 10% down. Now, you don't need to do 10%. You can do 5%, but I want to run this at 10%. That means that you're going to spend $40,000 out of your pocket. Let's say there's $8,000 in closing cost. And so you're 48 grand out of pocket, 40,000 invested, 8,000 in cost. Let's say that home appreciates at 2% per year. At 2% per year, your first year, your home value increased 2%. That's $8,000. That pays for your cost of buying the home. Every year after that, at 2%, you are earning a 20% return on your $40,000 investment of buying a home. This is why it's so important to change the narrative that if my home appreciates 2% per year, that's only $8,000 on $400,000. That is true if you're buying the home cash. But when you're leveraging other people's money, when you're leveraging a bank's money to go ahead and do it, you're actually earning a really great investment, a 20% return on investment at 10% down. Think about it, at 5% down, that investment doubles. You're earning 40% return on your money. It's massive. You also get tax write-offs. Your monthly interest gets written off. And as you pay that monthly payment, you're going to gain amortization. 5-year amortization, you gain another $21,000 in equity on your property by paying down the balance of your mortgage. That goes without saying. You get to paint it. You get to decorate it. It's your home. You can do what you want. And it gets you out of renting. Recessions. big key word that everyone's talking about right now. What's going on with a recession? I have been very vocal about it. I do believe we are in a recession. I believe we've been in a recession. I believe the term of recession is just continually being moved out on us. But overall, the numbers aren't going to lie at some point. Even the Federal Reserve has come out now and said they expect to see unemployment rise by 1.3 million job losses in the next year. It's definitely something that's coming down the pipe. So we've got to be cognizant of it. What happens to home values during recessions? The gray vertical bars here are periods of recession in our country. As you can see, in every recession we've ever had, with the exception of this one all the way back here, home values just barely dropped. And in 2008, when the recession was caused by housing, we've seen home values increase through every recession. Is that what we're going to see right now? We're going to see home values continue to rise? It's questionable. I do think we could see home prices correct just a little bit. That's not outside the realm of possible. Let's be honest, appreciation of 18-20% per year is not sustainable. If you wiped out 30% of the appreciation you gained over the past couple of years, you still gained unbelievable appreciation in your home. I don't think we're going to see 30%. I think we can see a 5 to 10% nice price reduction, nice correction in some of the markets. Some markets will remain very strong. Most markets will remain strong overall because of supply and demand. Supply and demand is the big issue we have in this country. Everyone right now is talking about why, we have so many more listings on market. We've seen this massive run up in inventory. And yes, that is true. But this is not something that is abnormal for a spring and summer market. You can see this every single spring and summer, year over year over year. We have a run up in inventory. Yes, this year's is higher. And this year is definitely more exasperated a little bit because of the higher interest rates have pushed some buyers to the sidelines. But the inventory shortage we have in America isn't going away. There's still a supply and demand issue, which is why housing should and will remain strong in face of recession in most markets. There are some markets that are heavily overinflated. We don't expect that to happen, but I'm not going to go into that right now. Let's go into inventory issues. Why do we have inventory issues? Why do we have a supply and demand issue in this country? This red line here is the median number of homes that we need to build in America to keep up with new families coming to market, obviously taking into account people aging out, people passing away, generations moving on. We need to build around 1.5 to 1.6 million homes per year in this country to keep up with simple population growth and family formation. And what we see here is the buildup, massive run up in the housing bubble, building way overbuilding. And then we see the crash. And we drop down to just about 400,000 homes being built in America. And this big section right here is the big cause of the supply and demand issue we have right now. We did not get back to a normal level of building. We peaked at it just a little bit at the beginning of 2020, but really until 2021, we didn't get back to a normal level of home building. This whole section right here is about 3.5 million homes that we're currently short for the market of. Yes, people have been priced out, but when rates come back down, people will come back to market, and those home buyers are still need a place to live, and rents aren't getting any cheaper. And so we got to look at the alternative. What is the alternative? The alternative is renting. It's a tough time right now in the market. Although the market's shifting, renting is always a worse option. We have people that complain about, I'm not paying 7% for a mortgage. Well, your rent payment's 100% interest. You're gaining nothing on it. All you're doing is pouring it into nothing. Homeownership is one of the greatest things you can take on. Rents have gone up nearly 20% over the last couple of years, and I can dive into the reason why on this. If we look at prior to 2019, single-family homes were never really considered an asset class of Wall Street. Over the past few years, the number of institutional investors buying single-family homes has gone through the roof to the point where one out of every 7 single-family homes in America right now is owned by an institutional investor. 1 out of 4 last year in 2021 was purchased by a institutional investor. So rents are no longer being set by the landlord down the street. Rents are being set by Wall Street. They're being set by the greed of Wall Street. Rents going up is not going to change. They're going to squeeze every single penny out that they can. At the end of the rental term, tenant exits and gets nothing. They have zero tax write-offs. Mortgage payments, although we don't like the interest rates we're at right now, they're going to remain stable. Yes, taxes and insurance can change, but the principal and interest is locked in on a fixed 30-year loan. That's not changing. You also can buy the house today. We call it marry the house, date the rate. I don't really love that term because we never know what's going to happen in this market, but theoretically, interest rates move in cycles. It's a cyclical market. Interest rates should be down in the future where you can refinance. You still get your home today and you can refinance and get a better terms on your mortgage in the future. And the benefit of appreciation and amortization. That's not something renters get. So I appreciate you guys taking some time. I want to go through just a little bit about the Epic Mortgage team because that's who I am and that's what I do. Back in 2015, I started as the Epic Mortgage guy that is now morphed into the Epic Mortgage team. I've got a picture of some of the team here. We're missing a couple people that weren't able to make it. We focus everything about speed, communication, education, things like this. I believe education is one of the biggest things missing from the mortgage industry to the real estate industry. This is what we live and breathe. We should be educating, teaching, and communicating. Our team is made up of multiple top 1% loan officers in the country. We love and have become experts at working with first-time home buyers. We feel like we're part marriage counselors and hand-holding. We love it. We've amassed over 1,000 five-star reviews. We are also condo loan experts. A lot of the team is in South Florida, which is condo heaven, and we do a lot of condos. We know exactly how to get them done. We know the pitfalls to watch for. We're a local lender. We got an office in Miami, Fort Lauderdale, Jacksonville, and Destin, and Atlanta as well. Sorry, forgot. We just added Atlanta to it. And we're also bilingual. We have loan officers that speak English and Spanish, as well as operations staff that do the same. Some key people on our team I want to touch on is myself. I don't need to talk about me. You guys know me. It's my business partner, Brian Kutu. Brian and I joined forces at the beginning of this year, merged our teams together, and we work day in and day out to create something that's truly epic in the mortgage industry, something that's not very often out there. Bridget Torres is the best of the best. She's our operations manager. As you guys know, if you're a real estate agent, you're only as good as your transaction coordinator. You can have the best skills in real estate, but if your transaction coordinator is horrible, the experience is horrible for your consumer. So we rely on Bridget to make sure that the operations side runs smoothly, and she does an amazing job. Since Brian and I are branch managers, we have Rachel and Jed that work hand in hand with us on every one of our transactions. We're oftentimes out in meetings. We're oftentimes teaching lunch and learns, doing things like this. And we can't always catch every call. So we each have a dedicated loan officer. I work with Jed Herman. Brian works with Rachel Bogue, and they work hand in hand with us on every one of our transactions. And last but not least, Mr. Michael Owen. I put him up here because he is the best of the best. Michael is basically an in-house underwriter that works on our pre-approval team as the pre-approval manager. And he comes in and reviews every single pre-approval before it goes out the door. And that is the single reason why we have such a high success rate with underwriting. Nearly 99% of our pre-approvals reaching a clear to close when they go to underwriting. Very, very low denial rate. This is me, my contact information, how to get a hold of me. I also have a Facebook group that's set up exclusively for realtors. Take out your phone, scan either one of those QR codes. I'm not going to spam you. I'm not going to sell to you. I put relevant data, housing data like this in that group, often 2 to 3, 4 times a week. If there's a breaking news thing about housing, we're going to drop it in there. I'd love to have you guys in there. And that's all I've got for you today. I appreciate everyone's time. And if you guys ever need anything, we're here for you. The Epic Mortgage team is standing by. We're in Metro Atlanta. We're in Fort Lauderdale. We're in Jacksonville. We're in Destin. And we're in Miami. So we're here to help you in any way you need. Appreciate your time today. Sorry for the long video. Hopefully it makes some sense. Now, if you have questions on any of these slides, if you want to use some of the graphics from these slides, if you want deeper dive on any one of them, reach out. You got my phone number, 904-500-EPIC. Take care, guys.